let's talk about taxes a little bit. And there are really two issues here. One is analysis of tax burden, and the other one is welfare. Okay, and under the heading of tax burden, our concern, and I want to kind of make this clear. So let's see.
Excuse me, Professor.
Yeah,
We're
can
still
you?
on the
Oh,
ignition.
okay. There. Can you see now? Yeah. Can you see the whiteboard?
Yes, thank you.
Yeah. Who's talking?
Benjamin,
Hey, Benjamin. How you doing?
good. How are you?
Pretty good. Pretty good. So Benjamin, I want to chat with you a little bit about this because I think this may be um, helpful. Um, us chatting a little bit. Are are you familiar with the differences between um, these two topics at all, or do you know what I'm talking about?
The differences between tax burden and welfare, correct?
Yeah, and the tax effects, welfare effects.
I haven't specifically don't know much about the welfare effect specifically, but um, I think I could kind of maybe piece it together as I go.
Yeah. Well, okay. So but you feel comfortable with the idea of tax burden, that you know what we're talking about up
Yes.
here. So can you give me an example? Like, what's our issue there?
Like I was thinking just as kind of say for us being living in a country where we all have a specific not specific but just kind of we all are expected to pay a share of tax in different kind type of ways, whether it's sales or just a payroll, that's kind of
Okay, yeah. So you're kind of like talking like informally, like the idea of like, oh, like, are we in a high tax or a low tax country? What's our tax burden, like that sort of thing? And I think that that's related, but we have a really we mean this in a really technical sense, and sometimes this analysis of tax burden falls under the heading of something else they call, which, like, where do the words come from? I don't know. It's jargon in our discipline, which just means like somebody made it up, and that's, that's what we're going with. It was long before me and long before you. You know what I mean?
Mhm.
So, but they're technical in that, again, almost every single thing we're going to talk about in this class they're basically code words, meaning like it's jargon. Only people that were educated in economics would really know this stuff. Um, and outside the discipline, um, people might have these other notions, like you're talking about, like, is it a high tax, low tax country? Like, what's the burden of taxation there? Um, and I should respell this: incidence. Um, the analysis of tax incidence. But in our discipline, when I say that something's technical, it means that almost always it relates to some math concept. Okay, so there's like something we want to measure. So, so tax burden, you know, so formally speaking, um, refers to the amount of the tax that is paid by this is where we get technical, the marginal participant in the market. And I should say this could apply to either the buyer or the seller. And I also want to be clear about something, is that this idea of being paid, I'm going to put that in quotes too, because it doesn't literally mean that they're giving a check to the government. So the government is something that members of society pay, but who do they pay it to? I'm waiting for your response.
Um, I mean, I was gonna say the government, but you just said that it doesn't necessarily mean the government. But
No. I didn't say it doesn't mean the government. No, I said I said that paid. I'm putting in quotes because I mean that they literally pay it. But you're right. Somebody in when something's taxed, right? When an item is taxed, okay, someone, it could be either or both of the parties, okay, in some sort of transaction, someone literally pays money to the government. That's what a tax is. And I'll tell you that in economics, from an analytical point of view, it doesn't matter what you call it. So I got into this big argument. So I've done a lot of consulting for government agencies, and one of the government agencies I think I told you guys that I've done a lot of consulting for is the South Coast Air Quality Management District, and they charge fees to polluters who pollute, but they like to call it a fee. But I told them when I was analyzing their stuff, I was like, well, yeah, I need data on the taxes that you guys charge. And they're a government agency, and somebody writes them a check. And there was a lady who was in there like administration stuff, and she's like, oh, she gave me some of the data, and I said, well, why didn't you give me this other data? And she's like, well, those aren't taxes, those are fees. Do you think that there's a difference?
in that context, not really, because they're literally the government, and they're the people are paying money towards them.
Yeah, and does it matter if they call it like when you pay your license registration, that they call it like a registration fee or whatever? It's a tax, right?
Mhm.
And so anyway, lest anybody in here ever gets confused, um, anytime you're giving money to the government, it is a tax, no matter what they label it. I think her idea was kind of like, well, it's a fee because if they don't want to do it, they don't have to like pay the fee, right?
Mhm.
But that's completely, ignorant of the idea that, well, with almost all taxes, you can do something to avoid them, right? For income tax, you don't have to work, right? You don't have to earn income. You can just decide, oh well, I don't want to pay the tax, so I'm going to, sign up for assistance and be homeless and unemployed or whatever, is the combination of things that means that you don't have to pay it. So yeah, don't ever get confused when somebody in some administrative capacity says, "Oh, this is just a fee," or they call it some other thing. It's all taxes um, in our discipline, and anytime there's money that's going to the government. So when we say it's the marginal participant, what we really mean is we measure what we'll call a buyer's tax burden as being the difference between the pre-tax price the buyer pays, and I'll put that, or the before tax price, and the after tax price. And to be clear, I should actually, the after tax price is going to be higher. It should actually be this way. Oh. And that's the BB stands for buyer's burden. And the seller's burden is the same thing, but this is the buyer's price. And I don't know if it's going to let me do this. So let me see. But okay. Try to open this up a little bit more. Okay. So does that make sense? I'm waiting for a response. No, I don't get it. Yes, I do get it.
Yes, it makes sense.
Okay. So, and I thought I heard a change in voice. Am I talking to the same person, or who am I talking to now?
That was Noah.
No. Okay. Noah. So the deal is this is so, and let's see, this is the other way. No, it should almost make sense. Okay, so this is the way that it should look. And I also want to note one other thing. It turns out that the tax itself is going to be equal to the buyer's burden plus the seller's burden. And that may not be obvious, but Noah, are you with me?
Yes, I'm here.
Okay, so you see, and let me do the dual arrows. You see these two terms, the before tax buyer's price and the before tax seller's price.
Yes, sir.
Yeah, those are going to be the same because it's going to be the equilibrium price.
Oh, clever.
You, what's that?
No, I said it's clever. That makes a lot of sense.
Yeah, so these two things will, when you add it together, one will come in with a negative sign, right? Here, and the other one has a positive sign. So they'll cancel each other out. And then the difference between the after-tax price the buyer pays and the after-tax price that the seller pays is just going to be equal to the total tax. So, you know, these are just like things to note. So I'll show you graphically in a minute, but we always analyze this from the perspective of the last person in the market. And so I want to make one other thing really a point before we move on to the next issue, which is so and Noah, are you with me?
Yes, sir.
Yeah, so these two terms where I have the double arrows, they're going to be P star. So I can rewrite this a little bit, and let me do that here. So I could write this as PB minus P star, and I can write this as PV minus P star. And again, let me try to drag it out a little bit more so it looks better. And okay, so oh dang it, I got it in the wrong order again. There. Okay, so before there's a tax, they both just pay the equilibrium price when they transact the product. But in reality, when the good is taxed, and this is kind of a little bit of a sticking point. I don't know if you agree with me, Noah, and it's okay if you initially don't. I hope to convince you what I'm about to say makes a lot of sense, because there are a lot of people that kind of intuitively don't believe this. So suppose you're transacting for some product. Let's just say it's paint. Okay. Are you with me, Noah?
Yes, sir.
Okay, so any idea why I chose paint?
Very seasonal. I don't know.
Yeah, well, okay, good point. It turns out that paint is one of the things that is regulated by the South Coast Air Quality Management District. And in fact, there are pollution taxes associated with producing paint, depending upon the chemicals you use. So back in the 30s, 20s, 30s, 40s, probably up to the 50s, because we really didn't have much environmental regulation until about the 1960s. I don't know if you know that or not, but yeah, it was a different world. People could put whatever they want in, didn't matter how much it pollutes. Do you know how paints pollute?
Not in modern times, but I know that it used to have like a lot of lead or all that kind of stuff. A lot of.
Well, yeah, so lead is one thing, but even in modern times, paints contain I don't know if you've painted, you smell it, it smells kind of good maybe. And
I mean, yeah, but we know it's not good for us, so I mean it's pretty given.
yeah. Well, though that fragrance, and it's the same actually like in cologne, when you spray it on yourself, the scent, why you can smell it. It has alcohols in it that generate these fumes, and you're smelling the fumes, right?
Yeah.
And those are called volatile organic compounds. They're a class of compounds that are associated with fumes. And so you can imagine, and this is probably a little bit, maybe more obvious. Some paints, some types of paints like lacquers, have lots of light oils in them. So, lots of alcohol type components, and they really stink a lot. They generate a lot of fumes. Some of them are even flammable. So, they're close to being like, a turpentine or, a gasoline type product. I mean, they're super, super volatile in lots of different ways. But they generate these volatile organic compounds, and the volatile organic compounds, you're right, they're damaging to human health. And so you can imagine when you talk about Los Angeles and Orange County, greater Los Angeles, Southern California altogether, everybody painting all the time with this stuff generates a lot of these fumes, and it damages human health. So they've been regulated since about the 1960s. But back in the 1950s, when people made paints, they just the seller charged a price and the buyer paid that, and there was nothing going to the government, right? So now these volatile organic compounds are regulated, and if you put them in your paint, you have to pay a fee. You have to pay something to the government. Now, here's the question. So let's say the price of paint before this was $20. So I'll put it down here. Suppose P star is equal to $20. Okay. So what do you think is going to happen to the price of paint? And now we're going to talk about it from the buyer's perspective. When you go down to Home Depot or Lowe's or maybe some hardware store or Dunn Edwards, and you buy a gallon of paint, once there's some tax put on it, do you think the price is going to be higher or lower than the original price of 20?
Higher.
Yeah, so make up a price for me. What do you think the price is going to be that buyers are going to pay?
I mean, just assuming just like the sales tax, then plus some sort of environmental fee or something. I don't know, a few bucks.
Yeah, let's call it an environmental tax. Okay. So yeah, so let's say PB now is, so after the tax, right? Let's suppose it's $25. So as a consumer, you're like worse off, right? You got to pay $25. You used to be able to pay 20. It's pretty easy to see that you're bearing a tax burden of $5 for a gallon of paint, right, Noah?
Yeah.
So but what about the seller? Do you think the seller is still going to get $20, or do you think the seller is going to get something less?
Depends if they take on any of the burden themselves. If they didn't decrease the price to account for the the fees, and then not give the whole burden to the buyer.
It's kind of a tough question, right?
Yeah.
So, but I think that you're kind of to getting it. And so the South Coast Air Quality Management District employs roughly 750 people. And a lot of them are inspectors and stuff like that. But they're also kind of like a brain trust, meaning, so they have about 100 or so employees, which is a big fraction of the people that they employ, that have PhDs in different types of engineering and chemistry. So just a bunch of smart people, and trying to figure out good ways to regulate the environment. But they come to me, and you know what they say? They say, well, so the biggest cost of any environmental regulation is that if you make local industry less competitive, they have to charge a higher price, then they'll have less customers, and ultimately it means that they're going to shrink. They'll have fewer employees. So there are a lot of costs you can count up associated with environmental regulation, but one of the biggest ones is the loss in jobs, right? If paints are more expensive, then people will paint less often, right? And paint manufacturers won't be selling as much paint. If you're a buyer, if you got to pay $25 instead of $20 for a gallon of paint, that's a disincentive, right, to purchase paint. So where you normally see that is in terms of the lost employment, is you see that the paint manufacturers are going to suffer decreased demand, and you can really see it because they're going to have to charge a lower price for their paint, meaning the net price that they receive after the tax is paid, so that they do bear some burden. So, and that's what almost all economic models, they have these very sophisticated computer models that generate demand and supply in all the different industries that are affected by a regulation. It's pretty interesting to work with the models because you get to see these effects. But if you're able to argue that the seller can pass all the tax to the buyer and still maintain the same quantity of output, right? So even though the price is 25, buyers are still going to buy the same amount, and the sellers don't receive any less in terms of their net price, then the models would show that there's not going to be any lost jobs, any reduction in employment in industries that are affected by the environmental tax. So there were a lot of PhDs in various engineering disciplines and chemistry that were trying to convince me of this kind of call them armchair economist points of view, that no, the paint manufacturers aren't going to be harmed. They're not going to suffer a reduction in their price because they're just going to pass the whole tax on to consumers, right? Which is kind of what you were struggling with a little bit, right?
Yeah, but I feel like that's probably the naive approach in that, because it's just going to reduce, it's going to affect like the quantity they can supply, right?
Well, yeah. So I guess so we've explained what buyer's burden and seller's burden are, but what we didn't do, and I'll try to do this just really quickly right here, is let's draw a simple demand and supply diagram. Here's the demand for paint, and here's the supply of paint. Oh. Okay. Now, I'll tell you the easiest way to model a tax, the one that I prefer, is there's our demand and supply diagram, is to shift the supply curve up by the amount of the tax. We didn't say how much this environmental fee is, but that's what this diagram is supposed to illustrate. Okay. So I simply shifted the supply curve up by the amount of the tax. Can you see that, Noah?
Yeah, that makes a lot of sense.
Okay, so that's the easiest way. There are other ways to do it. I could also lower demand by the amount of the tax. It doesn't really matter. But the point of doing it is to isolate this after-tax quantity of the good that's going to be traded. So hopefully, can you see the second equilibrium here, Noah?
Yes.
Okay, so this is going to be our after-tax quantity, and I'll call it QT. And you can see the difference between the shifted supply curves at that point. This distance, and I'm going to go ahead and remove the arrow. I'm going to put in a new one. This distance right here, let's see if we can get it in there. This distance right here is called the tax wedge. Okay. And so notice it's the same distance as the tax itself. So the tax wedge does measure the tax. Okay. And what economists normally point out, and this is what all the models say, I'm going to go ahead and put our original equilibrium price in there. If my diagram was a little bit easier, it'd be a little bit easier to see, and I may redraw it in a minute. But the QT here, where, and I'm going to actually go ahead and get rid of our tax now, because we know where the tax wedge belongs. This top part where it intersects the demand curve, and maybe I'll use a different color. That gives us the after-tax price that the buyer pays. I'll call it PB up there. And down here, we get the after-tax price that the seller receives. Okay. And then you can see in between, we have P star. So now, what this diagram basically tells us is that anytime we have a supply curve that's upward sloping and a demand curve that's downward sloping, those that obey the law of supply and demand, there's always going to be a reduction in the net price that the seller receives for the good after the tax is imposed. There's always going to be some significant seller's burden. And now I don't know if you can see clearly, but the buyer's burden and the seller's burden, which are, and are you with me, Noah?
Yes, sir.
Okay, so look here. See that little distance between PB and P star? That distance measures the buyer's burden, and the little distance down here between P star and PV measures the seller's burden, and they both add up to the distance that is the amount of the tax. Do you see?
Yep. Beautiful.
Okay, so yeah, I mean, we could imagine a situation, but it would really be an extreme situation where, for example, you had a vertical supply curve or a vertical demand curve, right? Which are really on the boundaries of what the law of supply and demand can handle, where it was possible for a seller to pass entirely the burden of a tax onto a buyer and have no effect. But in general, and in almost every real world reasonable case, that won't be so. So anyway, so we have this diagram, and this explains the burden. The thing that I said before, Noah, do you see this here? A paid and marginal. up here that I put in
Yeah.
quotes. So notice that this price difference here that the buyer and the seller end up having because of the tax is really evaluated for this last unit that's sold under the tax. Okay, that's what I mean by marginal, because that's where we evaluate the tax burden. And the paid here is, notice that usually what happens is, like in the case of the paint example, if a paint manufacturer in a gallon of paint includes, so how are you with your units of liquid measurement, right? So you have a gallon, right? And then you have a half gallon, and then you have a quart or a quarter of a gallon, right? And then what's the next unit that's smaller, like an eighth of a gallon?
Yeah, I guess an eighth of a gallon, or is it like a pint or something?
Yeah, yeah, so we're talking about something like that, like a pint, right? So suppose that you know the paint manufacturers put a pint of VOCs in their paint, so a fraction of the liquid content there, and as a result of that, they have to write a check to the South Coast Air Quality Management District. They have to literally pay in order to do that. So when the consumer goes to the paint store, and this is I think perfect reality, because when you go down to Lowe's and you buy a gallon of paint, they don't charge you an environmental fee, do they?
No.
No, no. You pay sales tax, but it's already embedded in the price that you're paying as the consumer, so you don't actually see it. But as a result of that environmental fee, the paint manufacturer isn't, and this is kind of in common dinner table language, they're not eating the whole environmental fee, right? They're not able to they don't mark down their product. Let's say, if it's $5 for the environmental fee, they don't mark down, the amount that they're going to get entirely. They pass as much as they can onto the consumer, but the extent to which they're able to do that depends upon the slope of the demand and supply curve. And we'll kind of talk about this a little bit more later when we talk about how the slope of the supply curve captures information about the cost of production. But even here we can see, well, on net, even though, let's say, the tax wedge is, I guess in our example here, we would say the environmental fee is something like, I'll just put a number here, is equal to $7, right? So in this example, PV, the seller's after-tax price, would be something like $18. So they're able to pass $5 off to the buyer, but they do have to eat $2 of that, right? So hopefully this diagram and the explanation makes sense. But the bottom line is that, yeah, as long as there's a reasonably sloped demand and supply curve, even though in this case, the environmental fee, the tax is actually being paid, $7 is being paid by the seller, and the buyer doesn't literally pay anything to the government, the buyer still is suffering a burden of the tax, because the price they have to pay for the product now is $5 more than they had to pay before. Does that make sense?
Plenty.
No. Okay. There's one other thing I wanna say before we move on about this, and that is that the word levy, as in tax levy, okay, is a legal word. It's an administrative word. And in this case, we would say that the way that we've modeled everything, that the environmental fee that we've talked about, the tax of $7 is levied on the seller, because the seller has to literally write the check to the government. That's an administrative requirement, but it isn't related to the economic burden of the tax directly. Even though they have a tax levy of $7, their net price is only falling by $2, right? It's the seller's tax burden, which was, we could calculate it here just so we're being, clear, but our seller's burden is equal to the $20 they used to get for their product minus the $18, which is they have a $2 economic burden, right? And the buyer's burden is the buyer now has to pay $25, and they used to pay $20, so they have a $5 tax burden, economic burden. So you want to make sure that you're able to distinguish between the idea that there's a levy, which is an administrative requirement, that is what we typically would think, oh, the amount of the tax is $7 on the seller, but the seller can pass on part of that tax to the buyer, such that ultimately the burden of the tax in terms of the net price that the buyer and seller are each paying after the tax divides the amount of the tax between them. Okay. Any questions, Noah?
None. That was very thorough.
Yeah. Well, now the next thing that we want to talk about, which we didn't, is this welfare effects, and I erased part of it. So which are distinct. Okay. So the welfare effects of taxation have to do with the changes, not for the marginal consumer or marginal producer, not the person that buys the last unit under the tax, right? The welfare effects are about the changes in consumer and producer surplus, and also total surplus, okay? So in our diagram that we showed before, and I'll just do this really quickly. Hopefully you can see, and I'll try to make it bigger. There's demand, and there's supply. Now, I am not going to draw the shifted demand or shifted supply curve to reflect the tax, Noah. Instead, I'm just going to skip and go straight to the tax wedge. Okay, so I'm going to start to draw the tax wedge here. Okay, are you okay with that, Noah?
Sure.
Okay, now what I want to do also is I want to identify the buyer's after-tax price and the seller's after-tax price. And so the whole reason I'm doing this, and I'll just put them over here, buyer's price and the seller's price is so we can see the areas that are really at play. And obviously, we have a pre-tax equilibrium price here, which I'm not identifying. But Noah, can you tell me what or where consumer surplus is now after the tax?
Should be the small triangle at the top, right?
Yeah. So it's this area. It's, remember the sort of like verbal definition of consumer surplus. Consumer surplus is always the area below the demand curve, above the price that the consumer pays, and to the left of the quantity purchased. So remember, the only thing that's kind of missing on our diagram here, and I think it's like pretty obvious, and so, again, I don't like to clutter the diagrams, is that there is the after-tax quantity, QT, and that's the quantity purchased and the quantity sold, right? So our verbal definition identifies this area here, which is in fact our consumer surplus. And then hopefully you can also see the area that corresponds to the producer surplus after the tax.
Yeah, it should be the small triangle at the bottom. Or I should say above the supply curve, below the price paid, and then to the left of the quantity supplied.
Yeah, and I'll correct you a little bit. It's above the supply curve, below the price the seller receives, and to the left of the quantity.
Yeah, received, not paid. That makes sense. Yeah.
Yeah, because they receive, sellers receive, right? So there are consumer and producer surpluses, and now we're running low on time. So do you have any quick questions?
No, that was golden. Thank you.
Okay, so who was holding on to our demand and supply from the previous example? I think it was Michael. What do you got, Michael?
Wait, I'm sorry, like Michael left me?
Yeah, I think you were the one that asked the questions about 9 and 10 on the homework.
Oh yeah, no. Yeah, I figured out what went wrong because I was calculating producer surplus using the new surplus line that includes the tax.
So you don't have any problems with 9 and 10 anymore, even though they're the same. It's okay.
No, yeah, they're the same because they have the same slope, but it's just one of them's negative and the other's positive. So that
Okay.
means that the tax is equally distributed between
Okay,
consumers and producers.
I feel so much better now. But I'll tell you what, remember Thursday morning is when we meet next, and hopefully after this lecture, you all have enough information to make good progress on the homework. So at least you can identify the questions that you're struggling with, and we can work through them on Thursday. Okay. Does anybody have any final questions for me? I will